had a very tough childhood. I went to a school for needy children, graduated from there. I was there for 10 years, put myself through college. I'd say my superpower is resilience, persistence, never being in a situation where I can't take care of myself financially.
Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on the journey from millions to billions. We believe the key to scaling and compounding your wealth starts every single day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more, all of it away. My name is Brett Swartz. In every episode, we feature some of the world's top entrepreneurs, millionaires, and billionaires, where they share their insight, wisdom, and secrets with us so we can scale and make a bigger impact for MVPs. I'm excited about our next guest. She's out of California. The company that she's working with is out of Arizona. And she's going to help us to worry less with debt investing. In fact, she has a really cool background, and she's the chief sales officer at Lukrom, which is a company we're going to talk about here in a minute. And her role is to lead and expand the company's sales team and efforts with a focus on investment professionals and their investors. For the past 8 years, she has acted as both the head of retail capital markets and chief service officer, and so much more. Please welcome to the show with me, Merriah Harkins. Merriah, how are we doing?
I'm good. Thanks for inviting me, Brett.
Absolutely grateful to have you on the show. For our listeners get to know you for the first time, would you give us just a little bit more about your story and your current focus?
Yes. So I have been leading national sales forces and helping to build distribution, which essentially is sales, for alternative investment firms over the past 20 years. So I have had exposure to lots of different asset-backed investing vehicles. I started my career with Vanguard and Schwab, and then moved into sales and leading sales organizations in the early 2000s. And I've had exposure to helping firms raise money for real estate-backed investing, venture debt, venture capital, equipment leasing, oil and gas. So I have had a lot of exposure to helping investors diversify their asset base into investments that are backed by real assets.
Excellent. And, growing up, I'm curious, who was Merriah? Like, what was your superpower, your strength? I believe you've all been given certain ones, and these help us to be a blessing and help to others. So what would you say is your number one or number two? Like, hey, Merriah always had this strength.
Yeah, so I would say, when I had a very tough childhood. I went to a school for needy children, graduated from there. I was there for 10 years, put myself through college. I'd say my superpower is resilience, persistence, never being in a situation where I can't take care of myself financially. And that has led me into a lot of focus on my career, focus on helping other people keep the money they have and grow the money they have so that you have financial security.
I love that. That's really great. Thank you for sharing that. With that being said, let's dive into the topic at hand, which is the worry less debt investing. So worry less debt investing. Tell us, Mara, what's the number one secret to doing just that?
Well, I say, I would expand that a little bit. Lukrom, what we are raising money for today, we do some development projects, mostly in multifamily with the eco focus. So, buildings that have solar panels on them that help to generate the common spaces being generated by the sun. We're based in Arizona. But right now we're, the main focus of our company and where the experience lies with our executives is we lend money to mostly Arizona-based businesses. The Phoenix metro market is one of the fastest growing markets in the country. So there's a lot of people that are either building real estate, improving real estate, taking homes and making them better. And so what our company does is we do short-term loans that range from 6 to 12 months. And we lend money to Phoenix-based businesses, again, that are purchasing real estate or improving real estate. And we have a first lien position. And so because they're short-term loans, we keep our loan to value, which just means our loan to value right now is in the kind of mid 50s, which means if you had a piece of real estate worth $1 million, we're giving a business a $550,000 loan. There's a lot of protection in that because you're very careful with underwriting to make sure that you're placing money with high quality companies, but you also have a first lien position, which allows you to take that real estate back if you were in a situation where the person didn't pay the loan. And so keeping your loan to value on the lower side provides a nice steady investment. Investors that invest with Lukrom can earn anywhere from 7% to 8.5%, depending on how much you put in. And we're taking that money and we're lending it to Phoenix-based businesses that are, again, either purchasing, developing, or improving real estate. And then typically they come to companies like Lukrom where they need a short-term loan. And if it's a longer-term real estate investment for them, they are seeking long-term loans. And so it's a bridge loan until they can get it. But they like to come to companies like ours because we can act very quickly. And so if they find a piece of real estate that they really like and need, and they can't wait around for bank financing because it takes longer, they'll typically come to firms like us. And so, investors, when I talk about worry less, you can invest in a private credit fund that is backed by lots of different things. Real estate tends to be very solid. If you're investing with a company that keeps their loan to value low, there's a lot of protection in that. And then if you're investing with companies that are kind of bridging different firms in real estate until the investor gets permanent financing, there's less risk in that. So, it just provides people an opportunity. I think there's a lot of worry right now about the volatility in the stock and bond markets. And so there's a lot of folks that are looking at, how do I diversify my portfolio into lots of different asset classes? And I may own my home, but I don't have rental real estate, or I have rental real estate, but I don't have anything that's backed by like a private credit type fund. And so it's the diversification into lots of different asset classes that provide a lot of safety and stability, because typically some of those asset classes are thriving when others are suffering. And if you're looking at super wealthy investors and you look at their asset allocation strategy, they tend to be spread across lots of different types of asset classes. And a lot of it's passive, which means they're running their businesses, they're running their lives. They want their investments to work for them without them having to be very involved. Let the pros do, their business in what they're experts at, and diversify your portfolio across lots of different asset classes to provide that stability and growth,
Got it.
so that you can focus your time on what you're an expert in.
All right. So it sounds like it's a private debt fund, 6 to 18 month loans, loan to value 55%. And you're able to provide an investor who wants to be in real estate but doesn't want to be subject to the stock market the ability to be passive and no toilets, no trash, no termites. They just receive a check. Is that a fair summary?
Correct. That's great.
So my thought, Merriah, is truly passive income is to our freedom and impact as compounding interest is to our money, and it's a practice that we try to help our clients, unlock. So talk about the value of truly passive income. I mean, this worry less, or worry free, like just how game changing that is for the people, for the clients that you serve and the investors you serve.
Yeah. So, if you are investing in real estate funds, you can invest in lots of different ways, and there's a risk spectrum. So even if you're investing in a private credit fund and you're investing with a firm that does a 90% loan to value. So for $1 million piece of real estate, they're giving the investor $900,000. Something happens with that piece of real estate. There's fees involved. There's time that you're losing because you have to foreclose on that property and then do something with it. So those types of investments where you've got high loan to values, even in the same type of investing private credit backed by real estate, there's a wide risk spectrum. Now, if you are investing in something that has a 90% loan to value, you're likely going to earn a higher interest rate from that company. But that's the risk reward spectrum, where if they're not careful and they're investing in their management, then you're taking a lot of risk and you could lose a lot of your investment. So it really, and there could be a place for higher risk investments and lower risk investments. We just particularly focus on very careful underwriting, keeping our loan to values lower so that there's a lot of protection for the investors. The other thing that's really unique in our fund is our principal and our advisory board and other executives have put $4.5 million of their own money in what's called a first loss position. And I've been in the business for a really long time. I've never actually seen principals do that, where you keep your loan to value low. You are really careful in underwriting the companies that you're willing to lend to. You structure this nice investment where you have a first lien position on the real estate that you're investing in. You keep the loans shorter. So you're keeping that money turning over. You have a $4.5 million first loss position, which means if there was a situation where the fund lost money, and we've said to you, your interest rate that we're paying you for the term that you're in, which you can stay in as long as you want to, is going to be 7%, or it's going to be 7.5 or 8.5, depending on what you put into the fund. The more you put in, the more money that you make. Every month, you're going to receive the same payment. At the end of the fund, you're going to receive your principal back. We're being good stewards of the money. You're receiving a good, strong, steady interest rate with a non-correlated asset to the stock and the bond markets. But you could also go with a much riskier fund and earn 10%. So, and there's a place potentially for lots of different types of investments like this in the portfolio. But for people that are interested in diversifying into asset classes they're not experts in, or don't want to go out and purchase real estate to lend out themselves or rent out themselves and be involved in that business, because let's just say you are a really successful person and you're in a fintech company, you're running a fintech company, or you're running a social media company, or you're running all different types of businesses. You want to be able to diversify into different types of assets that can work for you, that you don't need to worry about, but you're getting that nice diversification, which wealthy individuals tend to be more diversified than less wealthy. They tend to often take less risks in their investments because they're running their businesses and they may take risks there. And they are diversifying. They may have very risky investments that earn them the potential for a lot of money, but they're going to balance that out with lots of diversification that is on the range of being very, very conservative to very risky. And being really diversified, which you see lots of billionaires when you're looking at their investment portfolio. There's a publication that follows the asset allocation called Tiger 21, where you're looking at the wealthiest individuals in the United States and how do they do their investing. And most of their investments are not in the stock market and the bond market. They're diversified into these types of assets that provide more stability and diversification that range from really conservative to really risky.
Okay. Thank you, Merriah. That was awesome. Merriah Harkins, everybody. If you want to learn more, you can go to Lukrom.com. It's Lukrom.com, Lukrom.com. So, yes, makes sense. Our client, our listeners understand, investing in real estate, especially passive real estate and even passive debt. Talk about the returns a little bit. So you mentioned 7, you mentioned 10. So I love the first position. I think that is unique, what you guys have going on there. Whereas the first loss commitment, right, where your founders put up their capital into the fund and they're in the first loss position before investors' funds are at risk. That is unique for sure. Walk us through. Hey, have you guys ever lost $1 for an investor? How long have you guys been doing it for? How many loans do you guys do per year on average? What states are you guys in? Do you have audited financials? Walk us through a little bit about that.
Yeah. So, our history, as I mentioned, we do some real estate development, and we've mostly done that with family offices where they come in and they want to invest their money. Typically, we focus on opportunity zones, so there's the ability to defer taxes long into the future. So we have some experience in that, and at any given time, we raise money in those types of investments. Our founder has a long history in private credit, but more on the higher risk, distressed debt type of focus. And so we have transitioned our company where our main investment now is focused on high quality credits, short-term loans, keeping our loan to values low. So there's a long history in real estate and different ways of doing it. The first loss commitment, the first loss protection, that $4.5 million, oftentimes you'll see when you're investing with a firm in a fund, their principals will invest in the fund too. And people like to look for that. They like to look for, are you investing some of your own wealth in your own fund? Because then that shows that your interests are aligned with the investors and that you believe in the fund. Putting your money in a situation where you've put $4.5 million, and that will grow over time, where an investor, if there was any sort of loss in the fund, you're not going to feel it. So, if you invested $50,000 with us, the interest rate that you're going to earn is 7% a year. And if you invested $500,000, it's 7.5. And if you invested $2.5 million, it's 8.5. And you can pull family accounts. So if you've got different family members that want to invest in it to meet those breakpoints, you can. We have audited financials. We're very focused on, like I said, high credit quality and keeping our loan to values low, and having a first loss or a first lien position on the real estate, which is protective of the fund. We have not lost money for investors. We haven't had to dip into the $4.5 million, but it's there. And it's really, truly, when you look at principles and saying, are you invested in your own fund? Do you believe enough to put your money on the line? You don't typically see principals that are willing to put their money on the line and say, I'm going to take the first loss. So that's a unique aspect of it. But you do want to look at firms that, again, it depends on how much risk you want to take. Lots of different types of funds that you can go into all different kinds of private credit type investments with, a wide risk reward spectrum.
Got it. So I have a question for you, Merriah. So like some people, they want to be worry free, right, from this investing, right? They want to reimagine investing in real estate. They want to be done with the toilets, trash, the termites. You're in California. I'm from California. It's can be becoming more and more challenging to own real estate and own these luxury big primary homes and in the desert and on the coast, and the fires, and man, I mean, you have these business sales, and these people are getting older, and like, man, I got all of this wealth that's tied in this piece of real estate. I wish I could go and be into a private passive REIT where I don't have to do anything. That's debt. That's, higher returns, right?
Yep.
7, 8, 9%. But I have to pay all this capital gains tax, Merriah, right? So I want to be able to just go right into the debt fund, get 8 and 9%. But I don't know how to do it. Like, I don't want to sell we just helped a client. It's $13 million exit in San Diego. Okay. It's a car wash.
Yep.
Massive gains. Okay. And they have huge tax. So talk about capital gains tax as the barrier. And is there a way to 1031 exchange into your fund where they can still defer their tax, go right into your debt fund?
Yeah, so I'm sure you've had folks that have come on and talked about the DST or the 1031 structure. Ours is not. You can't roll into our fund to do that. So, but those are great structures. And for folks that don't want to actively manage, or they've reached a point where they've got major capital gains taxes, there are lots of different companies out there that do that. And it's an excellent choice for a lot of people that don't want to go into actively manage.
But what if there was a way, Merriah? What if there was a way where you could sell, defer your tax, and go into a private debt fund, all tax deferred? What if there's a way? Like, what would that mean for your investors and the folks that you guys run with? And what I'm getting at is there is a way, right? But most people don't know how to do it. In fact, they get it confused with the Delaware Statutory Trust. And because a Delaware Statutory Trust is a 1031 exchange, right? It means you have to trade like kind investment real estate for like kind investment real estate. And that's why the 1031 doesn't work into a debt fund. But there is another way. In fact, we call it the better DST. It's called a deferred sales trust. You may or may not have heard of it. Yep. It allows you to defer capital gains tax on any asset, Bitcoin, business sale, stock, real estate, and then you can go right into the fund. It's not a roll, it's an investment. It's just like a regular investor, or an LP or an LLC or whatever. You can just right into your fund. Like easy, right? It's actually really, really simple. We've done it lots of times. I'm curious, have you heard of that before? Are you familiar with that?
I'm not as familiar with, I know the DST structure and I know the 1031 exchange structure. I actually worked for a firm that did that for investors. I know that there's some way in which to go into a more diversified pool of real estate through like a 1031.
Yeah. We call that blockbuster, right? So what I'm saying is not that at all. Yeah. So I'll give you that example. That $13 million deal we did in San Diego, we put millions of dollars into a private debt fund that's very similar to yours, all tax deferred. We did another $8 million deal in Palo Alto, same thing. We just did a $8 million deal in Massachusetts for a business sale. We did a $2.5 million deal in Arizona, actually near Arizona State, I think Tucson over there. Okay. And we deferred all his tax, most of it into a debt fund. So what we found is that, truly passive income is to our clients' freedom and impact as compounding interest is to their money. And the problem is they can't get truly passive until they can sell the massive piece of real estate or business that they own. But then the other challenge becomes, well, if they sell, they pay this massive capital gains tax. And the other piece of it is they don't want to go into these lower return equity deals right now, right? They want to go into private debt because it's larger returns, right? Less risk, right? More diversification, right. Probably better liquidity, right? All of these things. And so, yeah, we solved that. And I'm just wondering, how many people you might be turning away who said, Merriah, I'd love to be in your guys' debt fund, but I don't want to pay 30 or 40 or 50% of my proceeds in tax.
Well, Brett, I would love to learn more about that because our fund is not structured that way. Our fund is structured to provide tax advantages. It's structured as a REIT, which allows you to defer or not defer some of your taxes, but you do have a tax break by being structured as a REIT. We do allow compounding. So when you talk about compounding your money, most people do. They don't take that income that we pay out on a monthly basis. They're investing it back into the fund. And for a 7% investment, if you're compounding and you've got REIT tax advantages, now that 7% turns to 8.1. If you're on the higher end and you invest $2.5 million and you've got family members in it to reach that break point, you start at 8.5, you compound it. With the REIT tax advantages, you're at 9.9. So there is the ability to do that. But no, we are not structured today to allow someone to sell a piece of real estate, defer their capital gains taxes. They can choose, as you're saying, go into a like-kind exchange in a 1031. So you have a car wash, you have to have something like that. Someone else is managing it. So you're receiving benefits from that without having to manage it actively. So there's lots of those opportunities, but I've not heard of the ability to go into a private credit fund and be able to do the same thing. So it's
if people want to learn more about it, you can go to capitalgainstaxsolutions.com. It's what we founded the company on, that whole premise that there's a better way than the old 1031 blockbuster that forces you into like-kind investment real estate within 45 to 180. And oftentimes you're overpaying, taking on too much debt and too much, not having liquidity or diversification, and you put yourself in a more compromised position. Instead, there's a better way. We call it the Netflix way of exit planning. Works for Bitcoin, businesses, real estate, all tax deferred. You can go right into private credit REITs. You can go private equity REITs. You can go to real estate but yourself. You can go to the businesses. You can go to stock market. You can put it into money market accounts, whatever you want. No timing restrictions, no like-kind replacement requirement. And the essence of it is an installment sale with the trust. This is why it works, because it's not a 1031 exchange, which is a continuity strategy where you're taking an investment and you're staying within the same entity and you're moving that entity into another investment real estate piece. In this scenario, you're actually selling the asset, getting a promissory note where the trust is, and this trust can invest any entity with all of its accredited investors is or all of its equity owners are accredited investors can invest into funds. And so that's the beauty of it. If you want to learn more, go to capitalgainstaxsolutions.com. Absolutely. Thank you so much for being on the show. And I also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels. We're here to scale with you from millions to billions so we can give more, all of it away for MVPs. And we're just on this journey with you. And so I want to encourage you to take action today. If you want some worry less investing, consider building a truly passive income plan. Consider looking at Lukrom as a way to diversify with passive debt investing, and also consider building a capital gains tax exit plan with us to get you there, right? That's the key. Like, where do you want to go? What would it mean if you had truly passive income and you could double your cash on cash return, all tax deferred? Don't wait. Get started today. Go to capitalgainstaxsolutions.com. You can also check out our book we have. It's called Building a Capital Gains Tax Exit Plan. We have Kevin Harrington from Shark Tank in the book, and we hit #1 bestseller on Amazon at one point, which is pretty cool. And we tell our story from zero to basically what we talked about with Merriah today, getting the capital to these private real estate, especially the debt ones that have better returns typically than the equity ones and better cash on cash. So check that out by going to Amazon or capitalgainstaxsolutions.com. Appreciate everyone listening or watching out there, and we'll talk to you again real soon. Bye now.